Financial stability in April 2021. Let's have a look. Hello everyone, Florian.Heise here and welcome to another episode of HeiseSays. Grab your stein of coffee because this is a follow-up from a video I looked at yesterday where we were discussing an article published in Yahoo Finance written by Jessica Yuan, RBA warning on what could cause spiraling debt, and this was in reference to the Financial Stability Review April 2021 released by the RBA, a 64-page or maybe more document that I thought we should go through, not in its entirety, but just highlights from various sections, and I will link to the entire document if you want to go through it, because in the Yahoo article, the concern was essentially building a case for loosening lending laws and bringing them in and then pulling in arguments from a lot of the advocates who are arguing against it. The 35,000 Australians who signed against it and all the charity and special interest groups that want to keep these regulations in for consumer protection. I would argue we need to advocate for individual agency. We're never going to have a push for financial responsibility and financial literacy in this country if we don't even realize people have individual agency. That's the point I'm making. And we can see how in the media people will pick and choose particular things to put a particular narrative together, and sometimes sadly it's always the negative. And I see it as a YouTuber, the negative articles get the views, everyone. The danger is, can you go down like the doomer or the perma-bear path and maybe miss opportunities, or reluctantly bet against the Fed or the Reserve Bank when they've got the magic money printer power, everyone. So I thought we'd have a look at this, and we'll start by looking at the global risk section. Now, key risks to financial stability, because that's what this is about. So key risks to the financial stability are similar in Australia and international. An incomplete or very uneven economic recovery would present risks to financial stability. And here, this is what I would argue the K-shaped recovery. And I suspect we're seeing that in Australia in different sectors. We're seeing that also in different countries, between different countries. Even here in Queensland, some parts of the state are doing real well, others are in trouble. And here in this example, technology, retail, software is going well, and travel, entertainment, hospitality and food isn't. If incomes remain below pre-pandemic levels in some countries as government support is wound back, it increases the likelihood that some borrowers will struggle to make their debt repayments, exhaust their financial buffers, and consequently default. So that is the concern that the RBA is highlighting there. Cyclical low interest rates and rising asset prices creates a risk of excessive borrowing. And this is where the article from Yahoo, spiraling debt, low interest rates, rising asset prices, they're shooting up and up. We're seeing that. Oh, you can't blame people. A range of asset prices, both globally and in Australia, have been rising. A channel through which expansionary monetary policy stimulates economic activity, and some appear high relative to their expected future streams of income. However, for most financial and real estate, this low rate of expected earnings relative to the asset price is broadly consistent with very low levels of interest rates. And I would argue, everyone, this is the Catalan effect that we're seeing manifest. It's creating bubbles in certain assets or products due to the flow path of the money into the economy. Money supply is being increased. Here, it's being increased as people can borrow more money. If now it's so cheap to get money, the cash rate, everyone, I will bring up, hang on, I will bring up the chart here, 0.1%. Remember, 3% used to be an emergency. Here, cyber attacks are a growing risk for financial stability. Over the past 6 months, there have been several high-profile cyber attacks worldwide. While the financial institutions were not specifically targeted by these attacks, some were affected. These attacks have demonstrated the increased sophistication of perpetrators. Financial institutions globally typically rate cyber as one of the most substantial risks they face. So that's something to also be aware, everyone. I think there was just another phone outage, another bank outage the other day. It's happening more and more. Prolonged economic weakness and an uneven recovery are key risks to financial stability. This is what they're worried about. The unprecedented policy response by governments, central banks, and other policy makers is contributing to global economic activity. I'd say in some ways it's supporting a lot of it. Recovering from the largest contraction since the immediate aftermath of the Second World War. Progress on vaccine development and rollout has also underpinned expectations for strong economic growth in the next 2 years. For now, however, employment is well below pre-pandemic levels in many economies. And we can see here the US labor force, not just Australia. Our unemployment rate shot up. It's right back down again, everyone. I'll just bring this here to show you. And you can see there in the US as well. And again, it's this K-shaped recovery. We're going to see it in different parts of the economy in different countries. So it's going to be interesting. This is why you'll see the push of this vaccine rollout and people wanting it to get out there so there can be at least a sense of a return to normalcy in the economy and economic activities. Equity and corporate bonds indicate an optimistic outlook. Now, this is one thing that you need to be wary of, particularly when you're consuming your media online or on YouTube, on social media. You could, if you might get the risk of being in like a bubble, a perma bear or a permeable bubble, and you just can only get one side of the argument. So, equity and corporate bond prices indicate an optimistic outlook. Progress on vaccines, expectations of additional stimulus, that's what it is. The market's been trained now for stimulus. In the US, and sustained low interest rates have supported a further rise in financial asset prices. Major equity indices are on average about 15% higher than their level before the pandemic. We can see here the equity risk premia and US earnings and GDP. There you go. Look at that. Boom. Investment funds can amplify asset price declines. The large rise in asset prices could encourage increased borrowing to take advantage of expected capital gains. This would increase the risk from disruptive corrections in prices. Such a correction could occur if government bond yields were to increase sharply, including if there is a sudden rebound in inflation expectations and if investors demand more compensation for uncertainty. This risk has been partly realized recently as inflation expectations increased in the US with the recent passing of an additional large stimulus package, though inflation expectations are not elevated. In late February, the increase in yields was exacerbated by low liquidity in government bond markets. The liquidity was not as severe as in the turmoil of March 2020 and did not generally spill over to other asset markets. Investment funds have the potential to amplify asset price declines given the leverage and liquidity risks as some funds, with these risks contributing to market dislocation. And we can see here, the corporate bond spread, everyone. It's just, I thought this was interesting, particularly with some of the big, private investors that are falling over that just were leveraged to the moon recently. Housing price growth. Now, we're not alone. Look at this chart, everyone. We're obsessed with housing price growth here in Australia. Look at New Zealand, guys. Look at New Zealand. I'll have to do a video looking at just what's happening in NZ. Look at this index, guys. This index is from 2017. So it's gone up over 40% since 2017, everyone. In New Zealand. Look at Canada. Look at the US. So Australia, we are nowhere near as bad as some of these other places, guys. Wow. That's just nuts. No wonder the Kiwis are having all of these issues, guys, and intervening in the market. Housing prices and credit growth are also rising in many economies. Housing price growth has increased in many economies since mid-2020, in part reflecting expectations that interest rates will remain very low for an extended period. See graph 1.3. Price growth acceleration in the later part of 2020, and in recent months, annualized rates of growth were 5% in the UK, 15% in Norway, 20% in Sweden and the United States, 30% in Canada, and 40% in New Zealand. Sorry, Kiwis. In addition to low interest rates, housing demand has been boosted by government policies that have supported household income and directly increased housing activity. Higher housing prices improve households' balance sheets, increasing economic activity via the wealth effect and activity associated with building and selling housing, and mitigating near-term risks that banks will incur significant losses on mortgage lending. Now, what I'll bring up here is just the actual wealth effect, everyone. Hang on, I'll bring up the wealth effect here. So, the wealth effect is a behavioral economic theory suggesting that people spend more of the value of their as their asset rise. So the more your shares go up, the more your property goes up, the more likely you are to start spending. The idea is that consumers feel more financially secure and confident about their wealth when their homes or investment portfolios increase in value. They're made to feel richer, even if their income and fixed costs are the same as before. So that's the wealth effect, everyone. And I know some people in the comments say, that's insane, that'll never happen. But it does. You know, we are reasonably simple creatures, everyone. And that's another reason why the government wants to hit the housing pinata to get it going up. Get that wealth effect. There you go, guys. Look at. So what this tells me is, guys, is this saying that Australian housing has room to move to catch up with the other states, other countries? Boy, how is it in NZ, guys? Let us know. So, risk elevation for small businesses. Risks are elevated in industries most affected by the pandemic and for small businesses. Corporate indebtedness increased over 2020 in advanced economies, including among the lowest rated borrowers, supported by accommodative financial conditions. Much of this borrowing was to increase firms' liquidity buffers, and some firms began to repay these funds over the second half of last year. Defaults in the corporate bond market and credit rating downgrades have increased over the past year, but remain below their GFC levels in both the US and Europe. However, defaults are expected to increase further over 2021. And here we have the debit at risk. We can see what changes to EBITDA. Here, what do you have? Total is down 10%. Energy crashed, down, up. But here you've got the debit at risk comparison from 2019. Energy's up, industry's up, consumer discretionary up, materials tiny bit up, consumer staples doesn't really change, real estate up, and other is up. So banks have been resilient. Now, this is something that a lot of people have been concerned about. Our banks here in Australia. Some people are afraid of a potential bail-in. I'm more concerned. I'm more concerned on an individual basis that a bank might assess you as a client they no longer want to do business with. They're not happy with your particular risk profile if you work in a particular business. And then they can just change their mind and say, we do not want to do business with you anymore, shut everything down and leave. I think that is much more likely to occur, and I've heard of that actually happening, than banks bailing in and taking all your money. So I would suggest you be a bit picky with your banks. You split up your business and your personal in different ones. There's also the all monies clause, where you've got money in the bank, they can just combine it all together. So keep that in mind, everyone. So globally, banks have been resilient to rising credit losses, but some would be tested by large rises in defaults. The regulatory reforms implemented following the GFC have been important in enhancing banks' resilience. The median of advanced economy banks' Common Equity Tier 1, CET1, capital buffers increased by around 7.5 percentage points between the GFC and the start of the pandemic. And we can see here the CET1 capital ratio from 2020 to now. Canada, it's increased. Europe, pretty much the same. Japan, slightly less. UK and US. UK is up. UK, I mean, that I'd read these all as pretty much the same. If we have a look here, where's that? Financial stability risks in China are elevated. So financial stability risks in China remained elevated despite the strong economic recovery. There are some long-running vulnerabilities in China's financial system that authorities have been working to address. These include elevated levels of corporate debt, weak capital positions among many smaller banks, an opaque and undercapitalized shadow banking system with strong links to the banking system, and widespread perceptions of implicit public sector guarantees. The strong policy response, starting with containing the virus, and the associated economic recovery have largely contained financial risks for now. And here's the non-financial sector debt. Well, I'll just let you, that's pretty, look at that, where that's skyrocketing. Look at bonds, bank loans, and shadow finance. So emerging market economies. Conditions in EMEs have generally improved, but financial stability challenges remain. The improvement in EME financial conditions since mid-2020 has come alongside the recovery in economic activity and global trade. Yields on local currency government bonds remain low relative to pre-pandemic levels for most EMEs, despite rising in recent months, while spreads on US dollar denominated bonds have generally continued to narrow towards pre-pandemic levels, graph 1.11. In this low interest rate environment, EME sovereigns and corporations have issued significant amounts of local currency and US dollar denominated debt. So we can see here government bond yields for Latin America. Oh, there you go. Yields are going up. Asia up and down. Exchange rates. So ongoing challenges. The global financial sector faces ongoing challenges, including from cyber risks and climate change. Cyber incidents pose a significant threat to the stability of the global financial system. The incident and cost of cyber attacks are increasing. In the past 6 months, there have been large-scale, high-profile attacks, including Celeron, Microsoft Exchange, and SolarWinds, that have impacted financial institutions as well as other entities globally. Domestic implications are discussed in Chapter 3, the Australian Financial System. These events have highlighted the potential for large-scale sophisticated attacks. The IMF has estimated that direct losses from cyber attacks could be as large as 9% of the total bank net income globally. So banking sector non-performing loans. This is another issue facing them here, and you can see, yeah, I mean, they're heading up, but they're heading down, particularly in Russia and India. So those are the global risks. Let's now have a look at Australian households, everyone. Because there are some things here that I think are quite important to have a look at. So overall, household finances have improved. Well, that happens when you pump so much money and government support into the economy. Household disposable income increased by 5% over 2020, boosted by temporary government income support. Improving labour market conditions contributed to income growth in the second half of the year. The program to allow households to access their superannuation early also provided a notable boost to household cash flow, with 3.5 million withdrawals totaling 36 billion, 3% of aggregate annual household disposable income, until the program's conclusion at the end of 2020. We can see here household liquidity and debt, everyone. Here we have the deposits. The deposits net of offset accounts. I thought that was quite interesting. Because, I mean, there you go. People are just piling money into offsets, and if the bank wants to, they can just, take that off your loan, guys. Here's household debt. And household debt net of mortgage repayments. So they're going down once you remove the mortgage repayments. Mortgage prepayments have gone up at 25% of household disposable income. There you go. People are getting ahead on their mortgages, and we'll have a look at that in a moment, everyone. Now, I've asked a question on my community tab asking you how far ahead you are at your mortgage. Let me know, guys, to get kind of a feel for it, because, well, some people are up to 2 years ahead on their mortgage repayments. Now, if enough people are ahead, that is going to, well, put a dent in the need for people to fire sale. They're going to be able to go a little bit longer. I think that the divide between those who are doing well and those that are not quite doing well in Australia is growing, and it's probably bigger than some people realize. So here's household liquidity buffers, the ratio of bank deposits to monthly expenses. So here's indebted homeowners. You can see they've got 4 months. Renters are up to 2 months. Outright homeowners are going down to 10 months. So renters and indebted homeowners, they've their households with investor and owner occupied debt, they've built up liquidity buffers. Outright homeowners have kind of gone down. They've lost a few months. But this is this is telling us something very different compared to the reports that are saying, oh, Australians can't even get $500 together. Okay, what do you trust? This is RBA Roy Morgan single source data, or the select telephone survey with 1,000 people. So, housing loan prepayments. Here's the interesting one. We have a look here. Look at that. Owner occupiers and investors less than 3 months, or less than 1 month, 1 month to 3 months. There you go. 3 to 12 months. So you've got what, 15% of owner occupiers are prepaid. You've got greater than 24 months. What's that? 35%, perhaps, of owner occupiers. Investors over 20%. Share of total housing lending. So from 2012, we were a bit over 10%. We're approaching 20% now. So, you know, and it's available redraw plus offset account balances. That's what they're counting here. Okay. So people do have some capacity to ride out difficult times with those mortgages. So with our cash rates so insanely low, even if it creeps up, it's going to start eating away at this for a lot of people. But, you know, they could go 2 years. They could maybe go cash. Maybe it'll make it a bit easier for them to get going, find other ways to save. So we'll have to, you know, I question if a dramatic rise in interest will, you know, knock a few people about. But you got to remember, these are people that are established. So it's going to be the first home buyers or the people who've just got in that may not have enough of that buffer. So that's the risk element. And it's the last people that are forced to sell that really affects the valuation of your property. So here's a really interesting one. Housing loans in negative equity. And of course, it's Queensland, WA, and others. So Queensland and Western Australia, yay! We're prominent on this chart here. But you can see that's also trending down. So from last year, it was what, 2.5%. Now we're at 1%. Look at that, the peak in 2019 when it went down. You know, so many people. Look at WA, guys, 2%, over 2% at negative equity in that time. Here we have ADI's housing loan characteristics, and here's the loan values greater than 90, LVRs greater than or equal than 90 for owner occupiers. You've got interest only. You can see it's going down. Interest only is a share of outstanding and investors. So let's now have a look at Australian businesses. We've had a look at households. It's now time to look at Australian businesses. So here's the profitability, the aggregate business profitability. We can see here revenue took a dive and expenses took an even bigger dive, and now they're climbing back up. And here's a change in profitability year on year. So, you know, it's climbing up. So here's cash holdings of non-financial businesses, months of expenses. So corporates have about 5 months, they've gone down, and unincorporated enterprises have about 2 months, a little over 2 months. So even the businesses have cash buffers or months of expenses. So there you go, everyone. 2 months is not that much, really. It isn't that much. So business insolvencies have begun to rise. Business insolvencies have risen from their mid-2020 lows, with the increase at the very end of the year coinciding with the end of the moratorium on director liability for insolvent trading. Looking ahead, it is likely that insolvencies will rise for some months. And we can see here it's shot back up and it's going back down again, but this here is the average. So if we just approach the average, guys, corporations and unincorporated enterprises seasonally adjusted, if we just approach up to the 1200 average, guys, it's going to be a lot of insolvencies. Commercial property risks. Commercial property risks are greatest for retail and also offices. Banks are closely monitoring their commercial property exposures that have been most affected by the pandemic, in particular the office and retail property markets. Impairment rates on commercial property lending remain low, consistent with relatively low LVRs and strong debt covenants leading into pandemic, but are expected to rise. And we can see here the office vacancy rates in Melbourne, Sydney, and other CBDs. We can see here the subleases have climbed up. Now, one thing that I will draw your attention to is This is from the Property Council, and I like to refer this because it just shows you the difference between what I would say the private sector and the public sector with regards to property, everyone. Just bear with me as I find this chart. So here we have the National Office Vacancy Rates. There you go. This is right after the recession Australia had to have. This is Canberra. So it wasn't made clear on that RBA chart, but there you go. Canberra didn't feel the impact as much as the rest of the state. So is that, or the rest of the nation. So is that what we need to do, guys? Do we need to invest in properties that have government exposure? Maybe those Centrelink tenancies are the ones to snap up. We've seen them going for very high levels. So here's office and industrial properties. Now industrial have been, there you go. I mean, look at industrial properties, guys. Look at the valuations. Face rents haven't gone up that much, but valuations, wow. There's office properties valuations as well. Effective rents haven't really gone up that much. The returns, look at the discount rates, they're going down. 10-year AGS yields going down, and spread to AGS is going down. So, the Australian financial system. Bank resilience is supported by their profitability. So, I know everyone doesn't like the greedy banks making their money, but a profitable bank hopefully won't be a bank that's at risk of falling over. That's kind of not what we want. Profitability recovered over the second half of 2020 as banks raised provisions for credit impairments at a slower pace than in the initial stages of the pandemic. Bad debts will rise over 2021 as fiscal support is reduced and a small share of loans previously granted repayment deferrals move into arrears. However, banks have bolstered their stock of provisions in anticipation of these losses. Current provisions are around 40% above recent years, though still below the levels in the aftermath of the GFC. And here are the provisions as a share of loans. There you go. There it was after the GFC. So we'll have to see. But there's been a lot more government stimulus and money pumped into the economy than during the GFC. Here we have bank valuations, forward price to earning ratios, and equity risk premiums. Here is the CET capital ratios. And you can see, well, for major banks, it's gone up. For other ASX listed banks, it's definitely shot up. And for unlisted banks, it's gone up. And some are above 20%. Now, what is the CET1? Just to remind everyone, it's Common Equity Tier 1 capital. It includes the core capital that a bank holds in its capital structure. CET1 ratio compares a bank's capital against its risk-weighted assets to determine its ability to withstand financial distress. Okay, so this is what they've got. Hopefully, it should be enough to ensure that we're not at risk of a bank default here in Australia, everyone. You've got to be careful that people will often use fear. Use fear of a bank risk, use fear of people losing their money, and then they will do that to sometimes sell you products that are complete bunk and complete cons. You know, and there's people doing that around Australia right now, everyone. So you just got to be careful of people trying to use fear to manipulate you. Well, look what's happened in the media and the news and the politics over the last year, all just the lockdowns, interventions that we've had. How much of that is driven by fear? How much of that is mass hysteria, everyone? How much of that will historians look back on and shake their heads? So here's banks refinancing tasks, banks non-performing loans. You can see here non-performing total, housing, past due is slightly creeping up, and impaired and past due as well. So, APRA is refining the regulatory framework. APRA is refining the regulatory framework for banks. In December, APRA released an update to its proposed revisions to the capital framework. These revisions will not require the banking system to raise additional capital, but will increase the flexibility of bank capital and improve the allocation of capital to risk. The reforms also embed the unquestionably strong benchmark within the capital framework and more closely align the measurement of capital ratios with the recently revised Basel III standards. The reforms will also make the capital framework more risk sensitive, which will reinforce the incentive for sound lending practices. In particular, high-risk type of housing loans, such as investor, interest-only, and highly leveraged loans, will require banks to hold more capital than equivalent owner-occupier principal and interest loans. The average risk weight on residential mortgages will also increase for the banking system as a whole, while there will be an offsetting decline in risk weights on business lending. APRA expects to finalize the framework in 2021 and implement it from January 2023. So with this changes to regulatory framework and banks required to have, well, hold more for higher risk loans, do you think we need to have these responsible lending standards that are being put in place? We need to remember agency of the individual needs to be respected. We need to push for it to come back, perhaps. Now remember the Ninja exit, guys. So Ninja, a small neobank that received its full banking license in September 2019, announced in December 2020 that it would hand back its banking license and return all deposits to customers. This decision was made in light of Ninja's inability to secure enough capital to offset its depletion of cash, resulting from paying more for deposits and operating expenses than it received on its assets, which did not yet include loans. APRA had been working with Ninja for some time prior to ensuring that if an exit was required, it would be orderly. In the event, APRA's contingency plans arrangements worked broadly as anticipated, and in the space of just a few weeks, more than 99% of deposits were returned directly to customers, with the remainder returned via new accounts at NAB. So there is some good news, everyone. Remember, we had a bank closed down in Australia last year, and it was quite orderly, and people got their money, no problems. Okay, so that is some good news there with our banking system. I know it's only it's a neobank. I mean, whoop-de-doo, but still, that's good news. How many crypto investments have people gone in that just disappear? So, non-bank financial institutions. Risks in non-bank financial institutions remain contained. General insurers' profitability declined to almost zero in 2020. We can see that here. Wow. However, they remain well capitalized, and analysts expect their profitability to recover in 2021. Analysts' forecasts for a recovery in profits in 2021 are underpinned by expectations that there will not be a repeat of the factors that reduced profit in 2020. Okay, so, I mean, what do you think, guys? Is this perhaps an investment opportunity? Have you bought into any insurance companies? Let us know in the comments your favorite shares, or do you stay away from them? So, domestic regulatory developments. So the Council of Financial Regulators, they want to end loan deferrals. A key focus of CFR has been recovery from the pandemic. Improving economic conditions in Australia have enabled a range of support measures designed to sustain houses and businesses during social restrictions to be gradually withdrawn. Financial institutions have played an important role in cushioning households and businesses from the impact of the lockdowns, included by temporary loan repayment deferrals. A key focus of CFR in the latter part of 2020 was the expiry of the majority of those deferrals in September and October, and borrowers transitioned to normal loan repayment schedules. So we'll see September and October, the transition to normal loan repayments. We'll have to see how that keeps playing out. Here's a very interesting one. Stable coin regulation. I saw this and I thought, well, this is definitely one all the crypto pundits will be interested in. The CFR has discussed a range of other topics, including stablecoin and e-conveyancing. The CFR has recently established a working group to consider the regulation of stablecoins. Stablecoins are a type of cryptocurrency that aims to maintain a stable value against a specific asset or pool of assets. This may make them more attractive to hold as a means of payment than other cryptocurrencies. Stablecoins came to broader prominence in 2019 with a proposal for a global stablecoin originally called Libra, but now rebranded as Demi, by a consortium of technology-focused companies, including Facebook. I mean, that would be interesting. that would be, really interesting to see if they could pull that off. Swiss-based Demi Association has more recently announced plans to launch single currency stablecoins intended for use in consumer digital wallets. It is applying for a license as a payment system by the Swiss Financial Market Supervisory Authority. While stablecoins do not currently play a significant role in the Australian financial system, the new CFR working group will consider how they would be regulated in Australia and whether any gaps in regulations exist. So, guys, there we have it. And the solution, well, jumping back right to here. Now, this article was entirely warning about a spiraling debt from the RBA. RBA warns on what could cause a spiraling debt. But there was so much more in this financial stability review, and I've only just touched on some of the more interesting topics that I thought we should discuss. One is the amount that people have prepaid on their home loans, everyone. That's something to keep in mind. If people have prepaid that much, housing liquidity buffers, even renters and indebted homeowners have got months of liquidity, a majority of them, months of liquidity in place. These are good signs for the economy. So, while they're focusing on the warning, the spiraling debt from the RBA, and understandably the calls from the RBA are going to be to implement lending restrictions and other standards rather than raising the cash rate, there's a lot more to it. We need to have a look at some of these sources as well. So guys, thank you all for watching this episode of Heise Says. Please like, share and subscribe to the channel. Let me know your thoughts and opinions in the comments down below. What are your predictions for the Australian economy in 2021? Do you think we're going to have a good finish of the year? Do you think these are signs that things are not quite as bad as we might anticipate? Or is it just kicking the can down the road? I mean, the fact that we're going to have debt at $1.3 trillion pretty much in 2024, well, you'd hope that that would kind of have a positive impact on the economy. As always, thanks for watching. Please like, share and subscribe to the channel. Let me know your thoughts and opinions on this one in the comments down below. If you're a fan of the channel and enjoy the content I create here, there are a few ways you can support us. You can join us on YouTube or Patreon. You can support us using our affiliate links on Amazon, eBay, Independent Reserve or AussieBroadband. Take care, guys. Have a great day, and I'll see you next time. Bye for now.